Well, let's talk about the next story, and this is a big one. The Ministry of Commerce and Industry has amended the Special Economic Zone regulations. Industry experts expect the new regulations to allow SEZ areas to be leased faster in the future, helping occupancy levels. To discuss what do these new SEZ amendments mean for the industry and what's the outlook basically from here out for the companies involved, we have Aravind Maiya, Chief Executive Officer at Embassy REIT, and Ram Chandani, Managing Director, Advisory and Transaction Services India at CBRE. Gentlemen, great to have both of you here. Appreciate your time. Prashant this side. Aravind, if I can start by asking you, what will this mean for your business? I mean, what is the vacancy, in the SEZ portfolio that you operate, and do you see an improvement in occupancies because of this notification?
Yeah, sure. Thanks. Good morning, Prashant. Thanks for having me on the show. Big picture, I think very positive for the sector. High-level numbers taken by IPCs. There's about 300 million square feet of SEZ space, of which around 20% is vacant as of today. The numbers growing. So what that means is this entire space becomes marketable as of now. So from a commercial real estate, anyway, we're already seeing growth in the form of global captives taking a lot of space. With this SEZ regulations out of the window, I think we'll have a twin growth engines to take our occupancy up to higher numbers.
Okay. Aravind, this 20% number, has it been increasing over the years? Has it been coming off? I mean, what has been the trend and what will this do? I mean, how much will this go down by vacancy? Yeah.
Sure. I think to give you a sense, I'll take our REIT as an example. In the past, we used to have close to 50% of the new lease up from in the form of SEZ space. That's now dropped to around 15 to 20%, right? That's caused as and when leases are coming up for renewal, people want more non-SEZ space. We can speak about it in some time as to the reasons as to why that's happening. But the space is going on increasing. It's moved up from say 10% to 20%, expected to go up further. But with this new regulations, effectively, we can market this space as a non-SEZ, subject to we demarcating it as NPA. So this should be able to kind of stem the increase in non-SEZ spaces.
Okay.
Or rather, SEZ spaces.
Sure. Ram Chandani is also with us of CBRE. Ram, your thoughts on these amendments that have come through? What kind of boost would this give to demand for commercial real estate?
I think stemming back, thanks for having me over. Stemming back from what Aravind mentioned with the 20% vacancy, that's approximately 38.5 million square feet of vacant space across the country, across the 7 major markets. I think the big opportunity is that occupiers who were not following the SEZ regime from the 2020 sunset clause, I think this gives occupiers an opportunity to go ahead and look at that space and co-locate their SEZ operations alongside their non-SEZ operations. That's one big plus. The second part is that with the growth of the office market again in India post the 2 odd years of COVID, we've seen absorption levels last year hit the 55 million square feet. This year again, we expect the year to close at 55 million square feet plus. I think the opportunity is that this is all quality commercial grade office, right? It's grade A office. I think this gives the opportunity for occupiers to consider these who are not working under the SEZ regime. And this is great quality space that's been lying vacant. Obviously, it makes life easier for them who don't fall in that regulatory environment of following an SEZ unit for their growth. And this will boost the overall leasing levels because in some of the key micro markets in India, there's a lack of quality of grade A supply. I think this will help occupiers to consider that space.
Got it. Thanks for that. Aravind, just to come back, so you said those reasons why newer people who've been coming in have been not coming into SEZ. Briefly, if you can lay them out. And second, with this change, how fast will the pickup be? Or will it take a lot of time to find new tenants, etc.? Go on.
I think in terms of what's happened is, historically, it was largely growth from tech occupiers taking up space in SEZ. 2020, sunset came into picture. Post that, of course, there's been the interest rate hike and then IT industry slowdown. So IT as a sector has not been taking a lot of space. Rather, they've been giving up space as a part of their portfolio rationalization. All the new space take-up are from global captives, and they don't want a SEZ space because, one, they don't have any direct tax benefit, and two, more importantly, they don't want to be in the physical constraints of a SEZ where there are a lot of regulations, because of which the new age occupiers prefer a non-SEZ space. That's the reason why the demand for SEZ space reduced over a period of time. So that's the answer to your first question. And in terms of timeline, I think we need to wait a bit, because while the regulations have come out and they've said that it requires a board of approvals, that's a BOA of SEZ, to sign off on this demarcation. What's the real SOP for it? I think we are waiting for that from government. We as an industry have represented for a single window clearance so that it becomes a much smoother and faster process. So we have to give it some time for the SOP to be in place.
Got it. Ram, I wanted your thoughts on the overall commercial real estate space and the kind of realizations, right? Because if you look at residential property prices, they've risen about 20-25% across cities. But commercial or office rentals are largely flat if you map it over a 6 to 12-month period. Why do you think that is? And what's your own view on how things may shape up in terms of office rentals?
One of the major reasons why our office rentals have remained fairly flattish is it's a supply-demand story, right? Obviously, with 2 years of COVID, where the absorption levels were much lower. Last year was a good comeback year. This year, as a follow-through in 23, has been a great year in terms of expansion, not just from the banking financial services sector. We've seen engineering, manufacturing sector, their GCCs expand here. The healthcare sector has dramatically seen growth. I think overall, for India being a large offshoring innovation hub for a lot of occupiers, I think the talent base over here is the biggest attractor for us in India. And that's really driving the growth for us in India. And if you look at the rental numbers, we've seen quality parks and micro locations that have accessibility to infrastructure, social infrastructure, amenities, etc., are the ones that are attracting the occupiers. If you create that energy in your park environments, in your business park environments, you have proximity to public transport, I think those are the parks that will see the growth. And that's what we're seeing across India. Whether you look at NCR, whether you look at markets like Bangalore, Chennai, Hyderabad, Mumbai, Pune, all these key markets have seen growth.
Yeah.
And this will continue to grow. I think amenitization of space is important. And just the employee experience that you create in these environments will be the biggest attractor for attracting tenants in these parks.
Aravind, same question to you in terms of sort of rentals and pricing. What's the expectation? What should we expect as we head into 24? One. Second, what is the SEZ sort of, what is the SEZ share as a part of your total office portfolio? That is second. And what kind of impact do you see to your earnings going forward as this sort of starts to become clearer and you're able to, give this space out in SEZs to newer tenants?
Sure. I think in terms of pricing, we've already seen the price go up over the last 12 months in the key cities like Bangalore, Hyderabad, Chennai. That's largely, as I said, because of increasing space take-up by global captives who want the best of amenities, which is what we offer, and they're not really very price conscious. They need the best of space. I believe with this, the demand for non-SEZ also going up, rather the SEZ converted to non-SEZ going up, we believe that the price should go up even further in the coming years. Just in terms of our portfolio, we have close to around 55% of our portfolio in the form of SEZ. And over a period of time, we see a lot more of these spaces getting converted to non-SEZ as the old occupiers give up space. What it means in terms of our earnings, I think we did clearly mention as a part of last quarter earnings that we believe the occupancy has bottomed out now. We were around 83% last quarter. Pre-COVID, we were close to 95%. This kind of gives a clear path for us to move the occupancy from 83 to 95, which logically should take the earnings up and the distributions up in the coming years. Would refrain from giving any specific guidance on the numbers, but clear growth path available for us in the next few years.
All right, we leave it at that. Thanks a lot for joining in.